Hi there, eToro. It is Monday the 13th of February, and that means tomorrow is Valentine's Day. Instead of doing the usual macro review for the past week, not much has changed. In the past week, I'm instead going to look at 3 of my portfolio companies and the earnings that they put out last week. All right, let's take a look. Starting with Digital Turbine. So Digital Turbine is a mid-cap kind of company. They're not tiny, but they're not a household name either. And they own a suite of products that allows companies to deploy advertising and various ways of making money on mobile phones. So they do this through a number of different products that they've acquired through the years. I'm not going to go through all of them now, otherwise this video would be too long. But they have an enormous moat in that they are probably the only company in the world, maybe besides Google, that can do this. They make money in a number of different ways. They've got different types of customers depending on the product sets that they sell. Some of their customers, for example, are the very large telecommunication companies in the US. But they also count among their customers companies like Amazon and I think Starbucks too now. Instead of going through the transcripts and all of the details of the stock, I've instead made a summary. I do this for each earnings report for companies that I follow. And let's start with the summary of Digital Turbine's earnings report, which was that it was very bad. I could probably throw another very in there. It was a very, very bad quarter for them. The stock plummeted more than 20% on the day following earnings, and it wasn't just because of the poor numbers that they put out there, which were bad on their own, but also because they changed their forecasts. The amount of revenue and profit that they're expected to generate through this year has dropped quite significantly versus the consensus. The question we need to ask ourselves right now, because there is a big slowdown in growth coming throughout the global economy, is are the numbers reflected in this particular earnings report down to the company becoming awful? Or is it because of the macro influences? The other thing to note though, and this is what makes it a little bit trickier, is that companies do stumble once in a while. They can have a few bad quarters, even if the macro conditions aren't very bad. And I'll talk about in a moment how I determine if my thesis around the company has collapsed, or if potentially they've stumbled, or is it just the macro conditions at the moment. All right, let's look at a few more details in my notes. Apologies for the formatting. I've copied and pasted from a few areas, and I rapidly jot down a few notes as I'm going through various pieces of information. So a few of the reasons mentioned for the quarter being so bad was that pricing, that's pricing of ads, has slowed down anywhere from 10 to 30% compared to a year ago. Now, this is not unique to Digital Turbine. This is just about anyone in the ad space will be affected by this. So if we look at, for example, the earnings report for Google or Facebook, we see similar kinds of trends within the details of those earnings reports. Now, Digital Turbine's product suite is focused specifically on mobile devices and not PCs. So they are quite sensitive to any changes in the sales of smartphones being shipped around the world. And so we know from, for example, the earnings report by Apple that smartphone shipments, smartphone sales have declined quite significantly. So the two key factors here are that people are spending less on advertising, which means that the price of advertising has come down. And also the number of people buying new smartphones or upgrading their smartphones has dropped significantly. Something to note that I've seen as a consultant working in dozens of companies around the world is that one of the first things to be cut in any business are the marketing budgets when there is some kind of a belt tightening activity that needs to go on. So ad tech companies are incredibly cyclical and they tend to lose a lot of their revenue early on in the downturns. But on the flip side, they also tend to be some of the companies that tend to gain back that revenue as the economy begins to turn. So in this awful earnings report, did anything good happen? Well, I'm not going to talk to every point, but they extended contracts with AT&T and Verizon for 3 and 4 years respectively. So that'll be very good for revenues and certainty around revenues. They've also seen margin expansion through this period and expect that to continue despite the downturn in revenue. They've added a number of high-profile partners, and they're seeing quite strong growth from some of their headline customers, which is good because any customers of theirs that see strong growth are likely to continue to invest in their product. One of the areas that they've been investing in quite heavily is an alternative app store. So at the moment, there's more or less a monopoly around app stores, and Digital Turbine is looking to get a foot in the door and create independent app stores. They would then be able to share revenue of these app stores with their partners, such as the one that they've created with US Cellular, and they could probably undercut the other owners of app stores that are out there at the moment. Listening to the call after the earnings report, the CEO was obviously unhappy about the quarter and the message that he had to deliver around the quarter just gone, as well as the forecast, but still remains fairly upbeat about the long-term view with regards to the business. What I found quite interesting in this last sentence here is that he believes that today marks the trough for his business, as well as the macro and micro issues that the company is temporarily facing at the moment. Now, I'm an optimist by nature, but I think that he might be slightly too optimistic. I suspect that there might be another quarter that's a bit rough for Digital Turbine, but because of the recent success of the company, and you can see evidence of this recent success in various ways. One way to see it is the strong growth and profitability through the past few years, and the fact that the company, just going by the books, is a very high quality business. After last week's earnings report, I was extremely tempted to add to my holding of Digital Turbine, but I think that I want to wait just a little bit longer to see how the next quarter also plays out before adding to my holding. So for now, the company is a hold, in my opinion. All right, moving on to the Walt Disney Company that also reported earnings last week. So Walt Disney is a behemoth of a company. They own so many different brands and types of businesses, which makes them quite a good company to hold at the core of your holdings, especially since the share price has been absolutely hammered through the past year or year and a half. Now, before we look at the earnings results and my notes around them, we should note that the ex-CEO Bob Iger, who led the company from about 2005 to about 2020, and then retired, has come back to the business. There was a bit of a coup that went on, and the CEO that succeeded Bob Iger is out, and Bob Iger is now back. I'll talk about the impacts of this and what he's doing as part of his return. Now, looking at the numbers, they had a beat on both earnings and revenue, which is fantastic, especially since we are in this huge economic slowdown. They are also targeting savings of $5.5 billion over the next few years, and they say that it's very likely that they will reinstate their dividend by year end, which is great. So why was this quarter particularly strong? Well, they had an incredibly strong growth within their parks, experiences, and products segment. You can see that the year-on-year growth here was about 21%, and the growth in operating income around 25%. So enormous growth given where the world is right now. Other parts of the business held up fairly well, but didn't do nearly as well as the parks and experiences area of the business did. But they have also managed to begin reducing expenses in several parts of the company. Now, Disney loves a reorganization every few years. I don't know why. If you go back through the earnings reports for the past 5 to 10 years, you'll see that they reorganize the company, and it's quite difficult to actually track the revenue across the different business units because the business units keep on changing. But Bob Iger is now back in the company, and he feels that a reorganization is necessary, and he's done this to ensure that there's fiscal responsibility for the people that own the various areas of the business. Other things to note are that Disney Plus subscribers fell for the first time, so this fell by 1%, so very small and kind of expected, given the cuts in subs that we've seen at other streaming services, and they expect to cut around 7,000 jobs within the company. You can read what the CEO has to say on screen. I'm not going to walk through that right now. It's a bit fluffy, but there is a lot of optimism from investors now that Bob Iger is back at the helm. So is Disney a buy, hold, or sell for me? Well, Disney is one of my largest holdings on eToro. I'm going to continue holding what I have. I think that the macro situation is going to be a little tough across the board, and so I have about 10% of my portfolio as cash at the moment. I want to wait and see if there is another big drop coming before picking up a few of these other companies that I already own in my portfolio. A few things that I really like about the company: it is incredibly well diversified. It is a large company. It's got very deep pockets. The share price is absolutely beaten down. And this is for a few good reasons. For example, they have taken on quite a lot more debt, as many companies did during that period when the world was in lockdown for 2020. However, revenue is going in the right direction. Profitability is going in the right direction. Yes, they are investing a lot of their profits back into the business to grow services like Disney+, but those should continue to reap rewards further down the line. All right, the last company that I'd like to talk about is Corsair, who reported earnings last week. And Corsair has a number of brands. It's fairly well diversified, although it is firmly within a particular industry. And it tends to be thought of in two kind of buckets, which I guess have some overlap. The first being gaming, and the second being streaming. Now, Corsair's results really surprised me. I expected them to have a fairly bad quarter last quarter, purely because people in the general retail kind of area have spent less over the last holiday period than they traditionally do. However, the company surprised, which is always nice, both in terms of EPS and revenue, despite revenue dropping year on year. What also made the market and investors quite happy is that their forecasts were more or less in line with expectations. So why did Corsair manage to do quite well through Q4 when many other retail style businesses didn't? Well, first of all, gaming and streaming, I think, is a growth area in the market and will continue to be so for the next 5 to 10 years. 10 years ago, very few people knew about streaming and influencers, and now just about everyone knows that these can actually be real jobs. But on top of that, there were a whole bunch of next generation GPUs and CPUs launched towards the end of 2022, which means that a new upgrade cycle is kicked off and people start looking for new peripherals and bits and pieces that Corsair supplies in order to build out their new machines or their streaming setups. There were also a few new games that were launched towards the end of 2022, and the new hardware combined with the new titles that were shipped towards the end of the year meant that retail sales for Corsair were actually above pre-pandemic levels in the last quarter of last year. A few interesting tidbits from the earnings report are that inventories were presenting a bit of a challenge, but it seems as though they've gotten over the hump there now. There are also a lot of big name games expected to be launched through 2023, which will be great for Corsair. They've managed to improve margins because prices in various areas have fallen down, including shipping. And they'll also be bringing a few new products to the market in 2023. Once again, I'll let you read through what management had to say. That's up on screen at the moment. But what I quite liked out of the earnings call was the fact that they expect the uptick from the end of last year to continue through the first half of this year at least. So is Corsair a buy, hold, or sell for me? Well, there is one big concern for Corsair that I'm keeping an eye on. And this is the fact that there are a lot of cheaper, lower quality alternatives that are out there. And if there's a downturn in the market and people can't afford the high quality products that Corsair sells, then they're going to move on to those cheaper, lower quality products, even if they don't want to, they have to. However, evidence from this most recent earnings report shows us that people are still willing to pay for the quality that Corsair delivers. And so for now, Corsair continues to be a hold for me. If we take a quick look at the numbers, we can see that the share price is still well off of the highs, the crazy highs that we saw in 2020 and 2021. But revenue continues to march in the right direction, as does profitability. The company has a huge amount of cash that they're sitting on. They did go through a capital raise so that they could invest in themselves once again. All right, so that's it for this week. A bit of a mixed bag when it comes to earnings that have gone on last week. I'll continue to be monitoring the situation. We do have a few companies reporting through this week, and perhaps I'll do the same thing next week too. All right, thanks very much. Goodbye.